Hey guys, Omar Khan here with Theta Trading, and welcome to another video. I hope you guys like the content we're creating. Before we get on today's topic, I want to reiterate what we do here at Theta Trading because I think it's lost a lot of the time. What really separates us from everyone else. If you want to learn how to be able to buy your favorite companies at a discount using a technique called selling naked puts and getting paid for it, this is a great way to create income for the rest of your life, and it can literally change your life. It changed my life, and just think of the concept. If I want to buy a company like Apple, and I want to buy it cheaper, well then writing a naked put is a phenomenal strategy, and I've been asked so many times, how come more people don't know about it? Well, the reason is I don't know the answer to that. I know it changed my life. Look into the strategy. I've done lots of videos on naked puts before, but that is a crux of what we do here at Theta. If you like this, please book a call with us. Let us know what you think. Let's get on today's topic. Before we do that, if you guys can hit that like button, it helps the YouTube algorithm promote our channel. Consider subscribing to the channel if you want to be notified of future videos. Hit the notification button. Now, the question today is, will there be a lot of more personal bankruptcies in 2023? Well, the U.S. banks just reported earnings, okay? So, again, not that I'm invested in U.S. banks, or maybe you're not invested in U.S. banks, but that's not the point. The point here is this. Will there be more bankruptcies? Let's take a look at U.S. banks and how they reported earnings into 2023. So first here, this is an article from Insider Intelligence, okay? So it's just a consolidation of the last four companies that reported, which is JP Morgan, Bank of America, Citigroup, and Wells Fargo. Those are the biggest banks in the United States. But one thing I want to take a look at in particular, okay, is loan loss provision. So let's go to the first earnings report, okay? So JP Morgan reported first. It blew past earnings and increased profits by 6%, okay? But let's take a look at this line here, what it says here. Loan loss provisions totaled $2.3 billion for the quarter, reflecting a 49% increase from 2023 Q3. Now, economists at the bank are predicting a mild recession to hit the U.S. in the fourth quarter of 2023. Now, why are loan loss provisions important? Well, what the bank does is it looks at all the loans it's made to people, right? And to, corporations and to businesses. And it says, well, how many of these loans are going to be not paid back? That's essentially what it means. It increased that 49% from the last year. So what does that tell us? Well, that tells us that the losses that they're expecting, the amount of bankruptcies they're expecting, could be substantial, okay? Now, that's the first bank to report, okay? An increase of 49%. So we all know what's happening. Interest rates are up. That means people's payments for their mortgages, their car payments, inflation is up. That means grocery store bills. All that stuff is very, very high compared to last year and the year before. And how is that going to affect personal bankruptcies? Personal bankruptcies and the ability for people not to be able to commit to paying their loans. Again, they're setting aside 49% more than they did the year before. That's substantial, okay? Now, everything else looked pretty good. Like I said, profits increased by 6%. Revenue was up to 35.57 billion. Substantial. Now, let's take a look at Bank of America. Okay, again, another big bank. Now, it doesn't say exactly here. It says it sets aside 1.1 million for loan provisions for the quarter. Now, that compares to 2.3 that JP Morgan set aside. So this is much higher than usual, okay? Banks don't normally set aside this much money for loan loss provisions. So what I would expect is I would expect a lot of personal bankruptcies in 2023. Again, for the reasons we mentioned, people will not be able to make the payments on their obligations, their car payments, their mortgage payments, other payments they have. They just won't be able to because rates have gone up so fast, right? A year ago, rates were 4.5% less. So if you had a mortgage or a line of credit and you're now paying 4.5% more, it's going to be that much harder because you didn't anticipate that to happen. Now, there's only so much buffer that people have, and that is being reflected in these bank earnings. Okay. Now, let's take a look at Citigroup. Citigroup says they report a 21% decline in profits year over year. And now again, let's take a look at this loan loss provisions. Loan loss provisions came in at $1.85 billion, the second line here. An increase of 35% from last quarter and higher than the analyst estimate of $1.79 billion. So again, you're looking at 35% more losses than the previous year in 2022. That is a problem, right? That tells you a few things. The economy is slowing down. People's ability to finance their debts is a problem. And that's why these loan loss provisions are up. Now, let's look at the last bank here, okay? Wells Fargo. Wells Fargo posted the biggest profit drop of 50% year over year. Not the end of the world. Revenues came in at $19.66 billion, just below $20 billion, which was expected. But again, let's look at credit loss provisions here. Reported at $957 million, reflecting the bank's unfavorable economic outlook. Now, you've probably heard it here many times. A lot of people are expecting a recession. Interest rates have been high for a long period of time now. The bank, the Federal Reserve Bank in the United States started increasing interest rates in March of 2022. Now they have increased substantially since then, around, like I said, 4.5%. That's substantial. People really weren't anticipating this to happen. But it has happened because inflation has been very, very high. So the banks have to increase interest rates to compensate. But the problem with that is that people are going to go bankrupt. They are not going to be able to make their payments. And again, Wells Fargo here has increased credit loss provisions to $957 million. So we're looking at 4 banks, and each of them have increased their loan loss provision substantially for 2023 because of the upcoming or pending recession that they anticipate because of higher interest rates that have been around for now quite some time. Now, interest rates won't go down, guys, until the central banks around the world feel that inflation is coming down, that people have been really, really hurt. You know, jobs are not being created anymore, and rates are going to have to come down to spur the economy on. But that has not happened yet. Right now, interest rates are still quite high, and they will stay high for a while until the central banks get their inflation target down to that 2% number they're looking at. And now we looked at, guys, we looked at 4 banks here: JP Morgan, Bank of America, Citigroup, Wells Fargo. That's a very good cross-section of U.S. financial health, not only in the banking sector, but the personal lending sector. And you can see across the board, loan loss provisions are up. So will there be a lot of personal bankruptcies in 2023? I would suspect yes, there would be. There'll be a lot more in 2023 than there were in 2022 because of the higher interest rates, because of the pinch that people are feeling. But the idea behind this is if they cause enough pain in the economy and they cause people to become poorer, which they're doing a great job of, by the way, then there will not be as much inflation, which means interest rates won't have to stay high for as long a period of time. But if I was a betting man, which I'm not, I would suspect that in 2023, you're going to see a lot more people filing for bankruptcy and companies going belly up as well. Because it's really hard to be able to sustain these higher interest rates for a long time. Now you can think about it, like imagine you had a line of credit that was, $500,000 that you were using to buy something. And I know a lot of people borrowed money against their lines of credits to buy secondary properties, to fund lifestyle perhaps, and at 2%, well, it wasn't a big deal. But now at 6.5%, it is a big deal. And that is why I think a lot of bankruptcies will occur in 2023. And we're already starting to see it. We're starting to see a lot more bankruptcies than we saw in the year previous. And this will continue as long as interest rates are high. Now, also you can see across the board here, you can look at credit card volumes are up 6% year over year. And this is now Wells Fargo. Here you can see Citigroup credit card spending volumes up 9%. Okay. Bank of America credit and debit card spending up 5%. Credit card balances grew by 14%. Okay. And lastly here, going back to the first one, JP Morgan credit card sales volume up 9%. So what does that mean? That means a lot more people are funding their lifestyle on their credit card. We know how expensive credit cards can be. So people are funding their lifestyle on credit cards. Their loan payments have gone up in every single which way. This is going to be a problem, and personal bankruptcies will increase. But at some point in time, guys, this will indicate that there's no need to have interest rates this high because there won't be enough money in the system. And once that occurs, the Bank of Canada, the Federal Reserve, can take their foot off the pedal and hopefully not increase interest rates anymore. In fact, even decrease them. Now, how does this relate back to what we do here at Theta? All right, what we do here at Theta is we agree to buy companies that we believe in. The only difference is we use a technique called naked puts, as I mentioned earlier on in the video. It is the best strategy in the world, in my opinion, investing. If I know I want to buy a stock, and you're going to allow me to agree to buy that stock for lower than its current market value, and you're going to pay me for it, and the worst thing that happens to me is I have to buy that stock, well, hey, that's a deal I'll sign all day long. If you want to learn more, watch one of our previous videos on selling naked puts. If that makes sense to you, maybe a light bulb will go off in your head, and you'll be like, wow, this is something that I've never even thought of before. Like, it literally changed my life. I never would have been in the position I am in currently today, which is a position of financial independence, if it wasn't for this one strategy. So if you want to learn more about the strategy, again, click on the link below. If you want to book a call with us to learn what we do here, do so. Otherwise, guys, we will see you next time. Thank you so much for watching the video. Take care and talk soon.